Most real estate investors think that as long as a rental income covers their mortgage, their taxes and insurance, they're making money. But the brutal truth is that's one of the biggest financial traps in the entire real estate game. And by the time they figured out that they're losing thousands every year in cash flow, it may be too late to get out of the property. Let me show you why before you make the same mistake that could cost you millions in gains down the road. I fell for the same thing when I first started. I was taught, Paul, you buy a home, you rent it out, you cover your mortgage, tax, and insurance, and sure enough, you get your mortgage paid for a while, and you make a lot of money. In fact, in one of my past videos, I talked about how I rented my house to Shaq. And his assistant, who I thought was a great guy, once said to me, well, of course you rented to us. You got your mortgage covered for a year. And I looked at him and said, there's no way I was doing this to cover my mortgage for 1 year. It was inconvenient, and that's not profit. The real profit comes after all the expenses. What are those? Maintenance and repair, capital improvements, advertising, utilities when the house is vacant, which does happen, keeping the grass cut, all these other things, permits, trash removal. Now you might be watching this saying, well, Paul, in my area, the tenant covers all those. Okay, fair enough. All of them, doubt it. Maintenance and repair, for sure, your tenant does not cover it. In fact, one thing I tell people is the worst mistake you can make is having your tenant cover maintenance and repairs. Let me ask you a question. Something happens in your house. And your tenant says, hey, I'll cover this thing. Just take it off my rent. Are they going to do an awesome job? Are they going to hire a good contractor to do that? Why would they? You have a leak, they're going to put a Band-Aid on it because all they care about doing is getting as cheap as possible, moving on to the next issue. That's it. Don't ever do that. And guess what? You might sit there and say, well, Paul, my furnace is brand new. My roof is brand new. Great. How long do they last? If your furnace and AC costs you $6,000 that lasts 20 years, that's $300 per year in costs you have to account for. Especially considering 20 years from now, it's not going to be $6,000 anymore. It's going to be $12,000. You got to double that number. Roof, same thing. These things are not cheap. Now, remember, if we're talking about renovations that increase the value, the rent of the property, things like bathrooms and kitchens, I don't include that in my budget. Because to me, if I can go do something in my property to increase the rent by 10 or 15%, why would I not do that? Another category, property management fees. Paul, I'm managing the property myself. I don't charge property management fees. Fair enough. But if you get big enough and you want to hire, even not a property manager, somebody to work for you got to pay for them somehow. That's your property management fee. When a semi-smart bank, I know that's not possible, when a bank that has a reasonable idea of what they're doing underwrites your property, they're going to put a property management fee in there. Why? Because they've got to operate the property and underwrite it as if they were taking it over. So even if you're paying yourself, you got to put it in that budget. Another thing, vacancy costs. Well, Paul, my tenant's going to be in there for 3 years and it's only one unit. Okay, well, what's 3 years? It's 3.5% vacancy. You gotta factor that in. All of these 5, 6, 7, 8, whatever number of categories, even though they're all small, if you add them all up together, they end up to be big money. And guess what? That roof every 20 years, that HVAC every 20 years, those windows every so often, every 30 years, 40, whatever the number is, they add up to real dollars when you put them all together. So let's say you buy a property that gets you $2,000 a month in rent. And it's rented for a long time. And all of a sudden, it goes vacant. Okay, well, your tenant moves out on January 1. Okay, they move out. It takes you a week, January 8th, to get it cleared out. You clean it all up, okay? Then you go another week, January 15th, to get minor paint done, carpets cleaned, the house overall cleaned, do some things around the house. Great. Now you get it listed by January 20th with all new pictures and everything. You gotta take those pictures because the tenant was in there forever. Now you show the property. All right, you show the property and in the first week, you finally get a renter, January 27th. Are they moving in January 27th? No, they're not. They put the application, they say, hey, you know what? I'm gonna move in March 1st. So in a best case scenario, you're 2 months out of rent. Even if they stay 3 years, you're out 2 months. That is 1/18th. That's about 0.055%. You might think that's not a big deal. Paul, 0.05, it's a big deal. But on $2,000 a month, that's $110 a month. So on a property that you might be cash flowing $200 a month or so you think, because it covers your mortgage, you're now in the hole 110. And by the way, question for you, the maintenance stuff that happened here, the painting, the cleaning, how much that cost you? Before you know it, you're massively in the hole. Now you might sit there and say, well, Paul, you're showing a worst case. No, I'm not. I didn't show you an eviction. An eviction when somebody takes 3 months to get out of there, plus cleanup. And guess what? Last time I checked, when I have an eviction, those aren't the cleanest tenants. And they usually damage things on purpose because they're so pissed off that they got evicted. This is not me making this up. I have over 1,000 apartments right now. I have over 85 houses. This happens all the time. Guys, what if they have pets? Well, Paul, my tenants don't allow pets. Oh, really? Your tenants did something that they weren't allowed to do? I am shocked to hear that. I've never heard of that ever happening. Hey, tell that to somebody who just evicted somebody for not paying rent. They're not allowed to not pay rent, right? All it takes is a few piss stains from a pet, and you have a very expensive carpet cleaning or carpet replacement job. People don't pay attention to the rules. Unfortunately, your job is to be the bad guy at times. Now, you might sit there and say, oh, Paul's saying if you don't have cash flow, you're going to lose money. I'm not saying that at all, especially on single family homes. The benefit of single family homes is they have another way of making you money. They're going to be sold to somebody potentially who wants it for their own personal residence. So the value is going to go up over time. And I've always said to people, let's look at it this way. Let's say you buy a $300,000 house as a rental, and you put 20% down. So you're financing 80%. What are you getting? You're getting a mortgage for $240,000. Okay, that $240,000 mortgage on a $300,000 house. Let's say you took a 30-year mortgage on it. After 30 years, you owe zero. Okay, well, what's the house worth? Well, let's say it goes up in value 3.5% or 4% per year. That'll make it worth about $1 million in 30 years. So you owe zero, the house is worth $1 million, your net equity is $1 million. How much did you invest to get that $1 million? 20% of the $300,000, $60,000. Your $60K became $1 million, 16.6 times your money in 30 years. What is that annualized return? That's about 10% per year. Guys, I didn't talk about cash flow anywhere over here. Zero cash flow. I'm assuming that you cash flow zero day one, and for the rest of the 30 years, you still make a 10% return. Now, if you buy a multifamily property where the value is driven by the profit and the cash flow, this is not going to work for you. But if you're building single family homes, you can still get away with no cash flow and still make a decent return on your money. Is it guaranteed? Of course not. But I look at this saying, the important part is you start out with zero cash flow day one. Now, of course, I'm here to teach you how to not do zero cash flow day one. I'm here to show you how you make money. Now, I have 3 vacation homes that I bought. These are all on lakes that my family's going to use, but we're going to rent out a big chunk of the time. On those ones, I want to make cash flow. But at the end of the day, if I don't, and I just do this process, and I'm able to use the homes and love them and enjoy them with my family for decades and still make 10% return, I have won. That makes me very happy. Because at the end of the day, you pay down debt, the property value goes up, and you get to enjoy that for my purposes. For you as a landlord, you also get tax benefits. You can write off the house, depreciate those things. So there's still benefits to it. If you have 30 houses at the end of the day with big mortgages, $200,000 each, by law, you can deduct those because that's a business expense. If you own those houses for yourself personally, you're maxed out on how much you can deduct. But over time, if you're able to take your cash flow and even get a little bit, let's say you say, okay, listen, I'm going to have cash flow break even for the rest of the 30 years, but every dollar of my cash flow I'm going to use to raise the value of my property. You're still going to make over your 10% because now every dollar of cash flow from day 1 to day 30, you can put into newer kitchens, newer bathrooms, a garage, a patio, all that increases your rent, which therefore increases your value. That's going to be so incredibly important. Now, what I told you guys here was ROI, the annualized return on your money. Now, a very popular return is called IRR, internal rate of return. IRR cares about when you receive the cash flow of the money versus ROI does not care. Let me give you an example. Let's say you bought a property, year 0, you paid $1 million for it, so you have a minus $1 million. Year 5, you sell it and you get $2 million. Or other situation is you pay $1 million here, year 1, you get $2 million, and then 0 for the rest of the 3 years. According to ROI, these are the exact same returns. On IRR, it cares that you got this money that much sooner. This IRR is so much higher because then you can take this $1 million and do it again. On this one, you got to wait 5 years to take that $1 million in profit and do it again. Here, you get to do it this year. If you do it again, you get another 2 million, another 2 million, and so on. At the end of 5 years, you own 5 properties in this situation. At the end of 5 years here, you only own 1 property. That's the difference between ROI and IRR. IRR cares about when you get the cash flow. Now, for that example, I want to show you. In our real estate calculator, we care about IRR. That's what we care about. The faster you get your cash flow, the better you are and the higher return is going to be. If I took all these cash flows and reversed them, put the higher cash flow at the beginning, lower at the end, total cash flow is the same, but the IRR is higher because I got the higher cash flow earlier. I did a refinance earlier. I did all of these things earlier. It gave me more money. Think about that. If you could pick when you get your cash flow in a 10-year long investment, what would you pick? Would you pick it all year 1, all year 10, evenly throughout, growing? You should want all the money year 1. That gives you all of your profit year 1 so you can go do it again over and over. Now, one of the other benefits of IRR is refinancing. If you look here in my example, I do a refinance. Look at my cash flow. It jumps from 465 to 2 million. Why? I did a refinance here. I get that money. I get to go do it again. And here's the great part. 2 million in cash flow. I spent $1.6 million here and 675 for all my capital improvements and boats and cars and all these things for this property, for these 3 properties. I can do it again in year 7. That's the goal of it. Now, what makes a good investment? Well, it all depends. How much work are you doing into it? If it's an investment that's basically turnkey and easy to do, 13 to 15% IRR, fine, solid. You're going to do well. The more work you do, renovations, tougher tenants, etc., you need to get 15 to 20% or more. That's a good deal. Anything below 12 or 13%, my comment back will be, hey, you can dollar cost average in low cost ETFs. Unless you really enjoy real estate and want the write-off, it's probably really not worth it for you. Now, there's a way to diversify through real estate, get those tax write-offs. You have something that's uncorrelated to the stock market. It's a great way of being. But at the end of the day, I want you to maximize your dollars and your time. Now, here's the good news. You might sit there and say, well, Paul, what if my property doesn't appreciate? Well, guys, we're a little spoiled to the negative side on what the last 15 years in real estate's been. Guys, apart from 2007, 2008, overall, the country's real estate values have gone up. Why? Because of inflation, because of the devaluation of the dollar. As people make more money, they spend more on buying their houses. The cost to go build a house goes up. So your house goes up in value because the cost to replace your house increases. This happens everywhere. You might be worried about population decline. I brought up this example before. Go look at Youngstown, Ohio. That's population has declined over 15% since 1980. And go look at Dallas, Texas. The population has increased 200% since 1980. Their appreciation rates are virtually identical because the devaluation of the dollar, inflation happens everywhere, and incomes go up everywhere. So what does that mean? You're better off going to markets that people find less sexy and they're bidding up prices a lot less. That way you can maximize your returns. Don't be that sucker like I was at the beginning where I said, oh, I collect $1,000 in rent. My mortgage, tax, insurance are $1,000. I'm breaking even. This is great. It's not going to work that way. Total equity growth. You're going to pay down debt. The property's going to appreciate. That'll happen over time. And if you're smart about your refinances and you do it every so often to get a big check tax-free out, it allows you to keep doing it over and over again. Now, I always hear people say, well, what's your return with depreciation? Don't ever do that. Depreciation should not be factored into your returns. Everyone gets it. Whether you're smart or dumb, you get the exact same depreciation schedule as everybody else. The only time I see people doing depreciation is when they're trying to pump up their numbers just a little bit. Now, guys, it's not hard to keep track of your real estate returns. It's very, very simple. I can help you out with that. The people in our community can help out with that. That's really important. With that said, I don't want you to miss the forest for the trees. I want you to be able to see the bigger picture with real estate of maximizing your returns and your cash flow. I want you to understand day one what you're buying and why you're buying it. And then I want you to focus after you close on the property on how to maximize the revenue on that property. If you're able to do that, I assure you, you'll wake up far wealthier if you do it consistently than you would have been before. because an okay deal in real estate is still better than the average deal in stocks. And that's what's very important to understand. So if you're interested in learning more about how real estate can be better for you, we are putting together a group. So guys, sign up for the email list. You'll get the emails when we talk about how I analyze real estate deals, example deals. If you're just thinking about getting involved just on the tertiary level, before you pull a trigger, that's the best thing to do. Sign up for the email list. It'll be a good reminder for you to keep your toe dipped in the water. And I assure you, you'll be better off because when you are ready to do it, you want to be able to hit the ground running. I don't like it when people say, well, I'm not ready to learn yet because I'm not ready to pull the trigger. That is absolutely asinine. Learn now so that when you're ready to pull the trigger, you don't make the same dumb mistakes that I made. Guys, I want you guys to understand something. When I do my real estate calculator here, because I focus on properties that I put money into, I could not care less what the cap rate is. In fact, my best real estate deal ever, I think I bought for about a 3.5% cap rate because the rents skyrocketed after I purchased it. That's what's key. Doesn't mean go buy a low cap rate. It means know what you're buying. Cap rate won't matter if the previous landlord's rents were egregiously low like the one that I bought. And it was my deal that got me 40% returns. Cash flow is just one piece of that puzzle. Investors who build real long-term wealth know which numbers to track and how to find a truly profitable deal. So if you want to learn more about that, we have a full real estate course video linked on the screen right now where we break down the most overlooked numbers that separate average investors from those who can scale fast and multiply their returns. Without this knowledge, you are absolutely leaving a lot of money on the table. I'll see you over there.